In this video, I'm going to talk a little bit about secondary market transactions. So when you are doing a secondary market transaction, you're buying, say, a share of stock in the stock market. A market order is an order to buy or sell at the current price. So if you put in a market order to buy a share of stock, you're saying I want to buy at the current price in the market. There are all kinds of other orders that you can put in as well. So you can put in a limit order, buy as long as the share of stock does not go over a certain amount. You can put in stops, which are basically triggers the order to go through if the stock price hits a particular price. In other words, buy if the stock hits a particular price level, then buy, and things like that. But for the most part, I'll just kind of focus on the market order, which is buy or sell, depending on what kind of order you put in, at the current price. Now, that brings up a few nuances about prices. So bid prices and ask prices. So let's talk about this a little bit. So a security buyer's maximum price in the market is the ask price. And the security seller's minimum price in the market is the bid price. Now, that might seem a little bit backwards. I know it just sort of feels a little bit backwards to me, unless we add in a key little detail. So if we are thinking about a dealer market, this will be a little bit easier. So I'm going to kind of skip down and talk about a dealer market for a moment. A dealer market is one in which there is a dealer that takes the opposite side of any desired trade. So if I, as an investor, put in an order to buy a share of stock in a dealer market, there is a dealer that is obligated to sell me that share of stock. So if that's the case, if we think about the bid and the ask prices from the perspective of a dealer market with a dealer in this process, and I look at that ask price, if I am a buyer and I am trying to buy the share of stock and I put in an order to buy, I'm buying from a dealer and the dealer is asking for a price. So he's asking to receive a certain amount of money in payment. And if I am an investor in a dealer market and I'm trying to sell a security, then I'm going to sell it to a dealer, and the dealer is going to be buying it from me, and the dealer is in effect bidding on that stock that he's going to buy from me, and hence it is a bid price. So if you think about those bid and ask prices from the perspective of a dealer, that terminology makes a lot of sense. So when I am buying a share of stock, the ask price is essentially what the dealer is asking me to pay him. And if I am selling a share of stock, the bid price is essentially what the dealer is agreeing to pay me to buy the share of stock from me. So that's kind of the idea of what's going on here. And that's why this terminology is the way it is, that the security buyer's maximum price in the market is the ask price. And the security seller's minimum price in the market is the bid price, because the bid and the ask are relative to really more the dealer in this context. Now, there are two different ways, having sort of gone down a little sidebar there, two different ways that markets can kind of function. And with these transactions, that is a broker market or a dealer market. So for a broker market, there's a broker who basically brings the seller and the buyer together, and then the price basically arises from the buyer and the seller, and so therefore the transaction is going to occur at the midpoint between the bid and the ask prices. So you look at the midpoint between those two, the buyer and the seller. Basically, that's where the deal occurs. For a dealer market, there is actually a dealer that takes the opposite of any desired trade, as already mentioned. And basically, the transaction will occur at either the bid or the ask price, depending upon which transaction we're looking at the moment. So again, if I am buying, I will then pay the ask price, the price that the dealer is asking. If I am selling, I will receive the bid price, the price that the dealer is bidding. Now, if you think about this, if the dealer has the obligation to take the opposite side of any desired trade, if I want to go buy a share of stock, that means the dealer has to sell it to me. He's obligated to do that. In order for that to occur, the dealer then has to maintain an inventory of stock. So the dealer is not trying to invest in the stock. The dealer basically has to keep an inventory just to make sure that the dealer can provide that share if somebody walks up through the markets and says, I want to buy. So the dealer has to maintain an inventory and therefore has essentially inventory risks, because for the dealer, as the price of that stock is going up and down, it's changing the risks that the dealer has associated with just holding the stock, because the dealer's not trying to hold the stock. The dealer's just trying to facilitate the transactions. But if the stock price is changing a lot, it kind of creates headaches for the dealer, and it can get kind of expensive for the dealer. So that brings up an interesting little note, and that is for stocks that have a huge amount of shares that change hands on a daily basis, the bid and the ask prices tend to be pretty narrow, basically because the dealer is buying and selling so much that the dealer doesn't have to worry that much about kind of the ability to buy and sell, and therefore the inventory of stock is not hanging around very long for the dealer, and therefore the bid and the ask prices tend to be very close together. On the other hand, if there's a dealer for a stock that is not traded very often, then the dealer has to hold on to that stock a bit more, and therefore price fluctuations kind of hit the dealer's bottom line more. And in order to try to compensate for that, the dealer basically generally is going to put in a bigger bid-ask spread, so a bigger gap between what he will ask when he sells the share and what he will bid when he buys the share, basically in order to make a little bit of money, and he'll want to make more money on that bid-ask spread to compensate for the fact that he's got a lot more risks associated with the fact that he's having to hold on to this stock that isn't trading much. So generally, the bid and ask prices will be a lot closer together for stocks that are trading a whole lot more, and thus, for a typical investor, probably doesn't, you barely even notice that there's a difference, because it's pretty close to kind of the quoted price out there in the market that you'll see. If you have a stock that doesn't trade very much, only a couple times a day, for instance, then generally the bid-ask prices will be a lot further apart, and it could actually be more meaningful for an investor. That might then matter a little bit. Okay, hopefully this video has helped to clarify some things about secondary market, stock market transactions. Thank you so much for watching, and have a great day.